Welcome back to Tip TV, and this is part 2 of my interview with John Mattingley. And if you remember back from part 1, he was just telling us about why he quit in the 1990s after losing £7,000, but it didn't stop there. John, welcome back to the show.
Thank you, Charlie. Yeah, it's once you start this and once you realise that you can actually do it, and if you're humble enough or at least self-aware enough to start looking at your mistakes, and I was reading everything. By this time, I was reading everything you could get your hands on. This was books. It was not, there wasn't much in the way of internet in those days. It was mostly books, but I'd plough through those books time and time again. And there was a couple of seminal books that I read, and I think I mentioned to you once before when we were talking about it's a guy called Douglas, Trading in the Zone.
Yeah.
And and I read that on the train going backwards and forwards, and I realised that the psychology of what I was doing was much more important. So I started to get back into it around about sort of 1995, 1996 again. And I actually ran a little sort of club with some friends at work, and we kind of did okay. We came out sort of just a little bit ahead. It was only about 4 or 5% ahead over a period of a year. But it was much more valuable for me than it was for them in terms of money, because it taught me about the mistakes that I was making. I think some of the previous interviews I've seen with you, people talk about not putting stops in, and I did that as well. Yeah. And I learned my lessons in all of those kinds of things. I learned so much more about risk reward as well. I would never conscience nowadays going into a deal that wasn't an asymmetric deal. Yep. It's just a silly thing to do.
And it's fascinating, John, because there's still a lot of people out there still trying to trade with inverted risk rewards out there. And there's bankers doing the similar sort of thing as well.
Well, they can afford to, you see.
Yeah, well, they can. It's not their money.
It's got balance sheets and
it's someone else's money. It doesn't matter. All it's about is generating commissions for them. But so yeah, there's still a lot of people out there, and it's interesting. You advocate that. But so you spent. From those late 1990s, you spent about 10 years of just watching the markets. You were busy, and then you got back into the markets in 2007 or?
I started to get back into in that period of sort of 2007, 2008, and that was partly because of my professional life. Yeah. I won't bore you with a big long story, but life took over basically. Yeah. And I was at that age where you're earning the most that you can, and I was being promoted through the ranks, and I ended up in quite a senior position in quite a large company. Yeah. So the last thing I wanted to do was trading. Yeah. I was flying all over the world, all those kinds of things. But sort of around 2007 and 8, I'd got involved in market regulation. And I could see an awful lot of what was happening. One of the things that I was lucky to have, for instance, was live streaming of the defaults in mortgages, for instance. It was just one of the streams that we had coming in as a result of some work that we were doing for banks. And in fact, actually, we got involved in unpicking some of these CDSs and CDOs. We had a couple of very smart PhD grad maths guys on board, and we were doing some work for some banks. So it got me reinterested in it, and it got me reinterested because I could see that what I would do on, say, a daily or a 4-hour, 30-minute, 5-minute chart was actually no different to what these guys were doing on, a 6-year bond, for instance. So the parallels started to hit me quite hard, and also the mistakes that these guys were making seemed to me to be like rookie mistakes that I'd made in trading, except the numbers were just out of control, as the world, found out to its cost. So that kind of got me very much more interested. And I thought, well, look, there's an awful lot I know just as a kind of discretionary trader that I can do on a much smaller basis. And I can also see that, the trajectory of one's career, it's like a bell curve, really. It goes up, goes down, and eventually I'm going to get to be 50, 60, and these guys are not going to want me anymore. So what do I do to make money for the rest of my life, as it were, and keep myself interested? And that's why I decided to get back into trading. So
where you are, so over these last few years, you've found a way to trade. What's your style now? Oh, generally.
I'm a discretionary trader. Yep. I've tried algos, I've written algos, I've done all that stuff.
We'll come on to that in a minute. Yeah.
Okay, it's a different subject. I keep things very, very simple. Momentum-based, trend following. I trade trends, I trade ranges, and I trade reversals.
Right. Okay.
Roughly what I do. So, and I keep it really, really simple. Support, resistance, pivot points, moving averages, and that's all I need. And then sometimes I keep it even simpler than that. When things get difficult, I'll strip it all back completely.
It's not rocket science, is it?
No.
Keep it simple, keep your risk under control, look for good quality trades, risk to reward, and you're away. Yeah, it's not rocket science, is it? And yet people complicate this whole thing.
Yeah, I know. Yeah, they do. You know what, Charlie? It's not that difficult. And I was going to say something that's sort of mildly controversial. Actually, if you do these basic things correctly and you have the right training and the right discipline, actually, it's quite hard to be a rubbish trader. You actually have to try.
You're right. The audience will love this because some of the people are winning saying, "What? No, I'm not trying to lose." Sorry, the people are losing. I'm not trying to lose here, but it's true. You're right. It's actually, once you get it, once the light bulb goes on, it does become more difficult to be bad. You're right. But it's just a case of, for each individual, everyone has their own switch, don't they? You had yours, I've had mine. Every trader has it, and once that switch is turned on, it does become quite liberating.
I have two Achilles heels. One is overconfidence, which I've managed to master now that I'm, of a vintage. And the second is boredom.
Yep.
But what I've realised with boredom is that's when I know what to do. When it's boring, that's how I know I'm doing well.
Yeah. Yes.
If it's all exciting and it's, and I'm getting overexcited about a big win or desperate about a big loss, not that I get big losses these days, obviously.
No. Yeah.
Then, obviously I'm doing something wrong in my mind.
Yep.
If it's even within that envelope as I see it, that's great.
Right, okay, John. What advice would you give to any trader? I do want to talk about some of the institutional side of things. We are running on time now.
Sure.
So what advice would you give to any trader who's watching this, that on your experience, what sort of three pieces of advice could you give someone?
Well, first of all, don't be put off by people telling you not to start, okay?
Yep.
A lot of people will be naysayers. When I've spoken to neighbours of mine or even friends, and I've said I'm doing this, they said, "Oh, I know blokes who do that, and they all lose their money. They're all, But then again, so do 95% of start-up businesses.
Yeah.
Unless you're Amish, of course, when 95% of the businesses actually succeed. But that's a different story. But, don't be put off by that. This is not a risky game. If you manage that risk, it's not a risky game.
No.
Opening a shop is a risk.
Yeah.
Building yourself a product, going out there and selling it and everything else, that's a risk.
Yeah.
Taking a loan from the bank.
So don't be put off.
Don't be put off. Secondly, don't think that everybody out there in the institutions knows more than you do. They don't.
Yeah.
Okay. I've worked in these institutions. They don't. Yes, there's some bright people there, but not there's not some kind of Lake Woebegone, everybody's better looking and better than average out there. It just doesn't work like that.
Yeah.
Lots and lots of average people are doing average things in the institutions. The only advantage that they've got over you is a balance sheet. That's the only advantage they've got. Don't think that they're all out there with algorithms that are beating you. They aren't. Most of those algorithms run flat, if that.
We'll come on to that in a minute.
Okay.
Final piece of advice to an independent trader that you would give them. The first piece of advice was, don't think that...
Discipline.
Yeah, okay, discipline.
Discipline, absolute discipline. Make sure you're healthy, make sure you're mentally healthy, make sure that, if you can, lead as much of a sort of monk-like Carthusian life as you possibly can when you're trading.
Perfect.
And also, when you're not trading, forget it.
Yeah, okay, brilliant. Okay, I'm just conscious of time here, and I really want to hear just a little bit more, just in this last minute or so, about, you've worked with institutions, like you say, you've written algorithms.
Yep.
What's your views for the average independent retail trader on robots or automated trading systems?
Forget them, don't even look at them. Complete waste of time. Absolutely. If you can buy, it's pure logic. If those robots worked, A, you would never even see them.
No.
And two, you'd never be able to buy them.
Yeah.
Okay.
Because you've written out algorithms at institutional level.
Yeah, that's right.
And that's still damned hard, yes?
It's hard. It's almost impossible to be.
Unless you've got deep enough pockets.
Unless you've got deep enough pockets. A lot of them are. There's several kinds of algorithms. If you're dealing with algorithms that are dealing with your customer's flow, like TWAP or VWAP or something, that's a different thing altogether, right? That's a flow type thing.
Yeah.
If you're dealing with algorithms where you're trying to beat the market and sort of ape what a discretionary trader does, you're on a hiding to nothing.
Yeah.
Even when you're talking about very advanced stuff, very advanced mathematics, where they're talking about artificial intelligence and so on and so forth. You know, I've seen quants absolutely tie themselves in knots trying to make this stuff work, and all that happens is effectively they sort of try and get through the next few months to the next bonus season and kid on to management that actually they're going to get it right sometime.
And so you've got all these quants out there that obviously they're taken on because they're very intelligent people,
Yeah.
but they're not necessarily these hedge funds that you dealt with, and we're not talking about everyone here. But
No, we're generalising.
Right, we are generalising, but there's a lot of funds out there.
Lots of emails about this.
There's lots of funds out there who are not making money. They rely on this stuff, but they're actually not making money.
No.
The average retail trader does have an advantage over these big funds, don't they?
Yes, they do. And the fact that they're doing smaller trades, for instance, helps for a start. So you don't go onto anybody's radar.
No.
You know, I mean, you'll usually, I think you're usually betting with 3 or 4 lots at a time or something.
Well, it's 5 times that, so it's about 20.
Okay, even so, at 20 lots a time, you're not going to be on anybody's radar. It's not, if you're a big institution, you're on somebody's radar. There's only about 10 institutions who can bet at that big level, and they all watch each other, and that's why you get stop runs and, you know, what looks like manipulation, but is actually just them chasing each other around in the marketplace, as it were.
Brilliant.
But that's all good stuff for us. That's what moves the market. If they weren't there, we wouldn't exist.
Exactly. We need to ride their coattails. John, I could just carry on talking, but we've run way over.
I know.
Thank you ever so much for coming on the show. And actually, I'd love to get you back on again and maybe talk some more about the institutional side of the business. That would be brilliant.
Whenever you're ready.
John Mattingley, thanks very much for coming on to Tip TV. My name's Charlie Burton. Thanks for watching. We'll be back soon.